I'm Keith McCullough, and welcome back to another Real Conversation with my friend Danielle DiMartino Booth. We tend to have some fun, but today's not really a fun day in kind of like our world.
Not in our world, no.
Yeah, maybe we'll just start with that and give at least what I tried to do this morning, which is a tribute to somebody who I had not been critical of and had a lot of respect for.
William McChesney Martin, he was it's the Fed's job to take away the punch bowl. And it went a very long time between his tenure at the Fed, which was the longest, and that of Paul Volcker. Mm-hmm. So those are my two central banking heroes, which is saying a lot coming from me because they were central bankers.
Yeah.
But no, the passing of Paul is just, it's devastating, and it reminds us of the futility of the people who have followed him and what they've tried to do, and how much against Paul's philosophy they have moved monetary policy, which I'm really happy that he was vocal about later in life.
Yeah, he was, and even I actually cited his book, unbeknownst to you, like when you mentioned it when you came in today. We never know what we're going to talk about, by the way. We know, generally speaking, what the topics are, the Fed. But this book that I was citing this morning, it's a must-read for anyone that's trying to put cyclical history within the lens of what Federal Reserve people said and did or tried to do within it. And there's this great passage here where he basically said where he got upset. James Baker was like all over him when Baker was made the Treasury Secretary in 1985, and he was of course politicized. But he's like, look, and this is Volcker saying this about Baker. He's like, look, he wanted everyone to think that we would keep interest rates low to support the depreciation of the dollar. I'd never made such a commitment.
Right.
Yeah, and he was very consistent with that. Through that period, and then
he never had ulterior motives. His favorite word was stability.
Right.
And that was what dictated his entire tenure. He knew that when he entered office, he had to make a decision between rip-roaring inflation and himself instigating a recession. So he knew he had a really bad choice to make, and he made it. And the country was better off for it in the end, and he was completely apolitical. I mean, he's the Saturday Night Special guy, coming out with announcements. He could have cared less if he shocked Wall Street or not. He was there to serve his country, and to take a 50% pay cut to move from the New York Fed to Washington, where he kept a little hovel of an apartment in Foggy Bottom and used milk crates as end tables, and his wife had to return to her job as a bookkeeper back in New York, and they had a very sick son, and his wife was ill as well. He made a tremendous sacrifice for his country. In fact, somebody actually had the gall to put on my Twitter feed yesterday, no RIP, goodbye 1%. And I went off. I never go off on Twitter. Well, sometimes I do. So I'm like, do you dare put him in with elitists and the 1%ers? He was the antithesis of that. He was a true public servant, and we shouldn't think of him as being anything but that. And I was kind of hoping the same thing would happen with Powell.
Well, you have, on Twitter is where you're definitely going to find the classic comments of the unaware, the uneducated, the unaware, and it's our job to, I think it's our job, I think it's my service, I'm sure you feel the same way. It's my service is to educate, or at least try to educate myself while I'm educating other people on what actually happened.
Somebody tweeted out this morning, it's like, don't call me an expert.
Yeah.
I'm not an expert. There is no such thing.
Yeah.
There are people who try and hone their intellect by never stopping the learning process.
Yep.
That's what I am. That's what you are.
Yeah, and what's really interesting about Volcker, and we'll get into kind of today and all that, because this is so long forgotten, and largely macro unawareness feeds on that. But 1982, inflation coming out of a recession, his choice was to raise interest rates and strengthen the dollar. Like, again, inflation, for those of you that don't know, he took it from 12%, literally through brute force and instruments that we know.
Fed funds rate at 20%.
Yeah.
Can you imagine?
And you took inflation from 12 to 3, okay? Now, where inflation's falling below 2, and people, everyone on Wall Street, their number one thing to beg for is the literal opposite. The literal opposite of what he would have believed. He'd say, hey, look, if you devalue the dollar, the cost of living of the people goes up. Why would we do that?
Exactly. And he was, he wrote in 2018, he wrote this great Bloomberg op-ed, writing about it this week, that was basically talked about the fallacy of the 2% inflation target and how idiotic it was. You don't target, cutting the value of a dollar in half over a 50-year period. Nobody does that. It's like, I'm targeting failure. No, it makes no sense. And he was bold enough to come out and say that what Bernanke did was wrong. And there were 2 straw votes leading up to. Bernanke held a straw vote in 10 and 11 and found that he did not have the support of the committee to impose this 2% inflation target. It was not until January of 2012 that he did. And he prevailed only by promising that he would not impose an unemployment target. He reneged on that in December of 2012. And we remember how well that worked out for the Fed, having an unemployment rate target.
Well, targeting...
they had to move it down, and then cancel
Targeting anything in the natural state is ridiculous. Only somebody who doesn't believe in nonlinearity and rate of change would try something like that to start. But if you go back to maybe the point, which is, I think most people, at least you and I, would say that he had a moral compass. He actually stood for the people, he stood for Main Street, and it worked.
Right.
Like, why is it that Bernanke, even Yellen to a degree, I think she looked much more innocent just by virtue of her not being as brutal as Bernanke was. But Bernanke devalued the dollar to a 40-year low in 2011 and said that there was no inflation. When the cost of living, and this is where the inequality gap really started to widen. I mean, I don't think that there's anyone who could unpack that and say that the Fed had nothing to do with it.
Well, look, and some of this goes to the smoke and mirrors of the inflation target that they're using, which, the PCE takes into account healthcare inflation as that of Medicare and Medicaid reimbursement rates. I mean, hell, that's not what you pay. That's not what I pay. That's not what anybody on planet Earth pays. They underrepresent housing. And these are things that are well known inside the Fed. This was recognized in 2009 and in 2010 when I was inside the Fed that, we've made a big mistake. We've got the wrong target. And they chose to do nothing about it.
Is the whole discussion now about a higher target just another way of saying that our target doesn't work?
Well, yeah, I mean, I'm intrigued that they're like, well, maybe we can let inflation run a little hot. I'm like, well, you could if you actually counted it correctly. And then you'd find out that we were already on fire. If you were to bring into account, apartment rents and home prices and stocks and bonds. But no. But maybe we should let the bad inflation metric run hot. You can't even hit the 2%. What makes you think you're going to hit 3%?
Does it matter? Do you think the market even cares about their target?
I think the market cares about what they think their target should be.
Yep, I agree.
Because as long as they have that falsity to hide behind, they have license to keep printing money. And that's all the market cares about. So the market knows, you can make the bullseye this big, they ain't gonna hit that PCE target of 2%. They're never gonna get there. So they will always have this, oh dear, inflation's running too cold, shield to stand behind and say, therefore, ergo, we must print more.
Well, it's hard to fast forward from all of what we've talked about, in 9 minutes to where we are today. But today, like James Baker, a lawyer, a successful one, I believe, from Houston, a Texan who was politically, again, dynamic and certainly involved, to a lawyer today, and for those of you that don't know why I call him P.E. Powell, or Private Equity Powell, he's a former lawyer at the Carlyle Group who's well compensated for being a great lawyer. Who is he today relative to who you could have wanted him to be in Volcker?
Well, in theory, Jay Powell's resume was pretty where we wanted it to be. I mean, this is the guy who in October 2012 said that the Fed's QE policy was creating a fixed income duration bubble across the entire credit spectrum. Okay, so he knows what he's talking about, and he knows what the Fed's policy has done. And in the beginning of his tenure, before the credit markets threw up in a year ago now, in December 2018, it looked like he was sticking to his guns. It looked like he was saying, it's not the Fed's job to backstop the stock market. And it was great. I mean, there was the kumbaya going on, at least with me.
Me too.
Publicly.
And he'd say it like quickly with like, he'd be,
and
brevity
he
was
said it with authority.
Yeah.
As opposed to the Powell who we have today, who is clearly not comfortable in his skin. He knows what he's doing is wrong, but I think unlike Volcker, he got to the edge of the abyss. He had a choice to make between two really bad outcomes, and he chose to make neither.
Now, you wrote, and this is actually a very good piece, and for people who aren't like crazy Fed watchers like us, I mean, or crazy people who worked at the Fed,
For
like
people
you.
who have a life, you mean?
Yeah.
For those people?
You just wrote, and for those of you that haven't seen it, you can see it with the bubbles and everything else. But again, can the Fed slowly deflate the credit bubble? That's the ongoing question. That's the question any buy-sider worth, part of their next job, even if they don't have a capacity to have it, because a lot of people are struggling running money these days. But almost everybody knows, and if they don't know that there's the most corporate credit in human history, now they know. But how?
It's only 74% of GDP. My gosh, we could get to 100. We could overachieve.
But you're now saying, as opposed to being reactive, as all Federal Reserve people have been since Volcker. There is actually a proactive nature to this guy,
and this completely breaks the mold. And I would not put Volcker in the same camp as Bernanke and Yellen, and even Greenspan. I wouldn't, because he did react to really high inflation by putting the U.S. economy into recession, and he made a lot of enemies. And I've seen a lot of, anecdotes in the past 24 hours. My hometown had 50% bankruptcies, never recovered. He made a really hard decision. Powell is choosing to circumvent making that hard decision because he saw in December 2018 that the credit bubble was set to burst. And so he decided that, unlike Greenspan made a very famous speech because he recognized the irrational exuberance in the stock market in December 1996, and he chose to do nothing about it. His advisors said, well, we could raise margin requirements. We can get out in front of this mother of all stock market bubbles. And Greenspan said no. The only thing you can do to address a bubble is in its aftermath. And that was Bernanke's philosophy. He adopted it, and Yellen adopted the same philosophy. So even though you have sufficient identifiers, you're not going to do anything about it until you're coming in as the cleanup crew, or as Jim Grant would say, the Fed is both arsonist and firefighter. Jay Powell's breaking this mold in a big way. This is a huge gambit. He has seen what the bubble could be. He watched liquidity dry up in November and December of 2018, and he made the decision to, a few discussions ago, we talked about this idea, this ludicrous idea of rate cuts and QE ongoing at the same time. Well, guess what, boys and girls? So I think he's decided to try and get out in front of this and see if he can prevent it from bursting and maybe just have the air come out of the balloon slowly.
That sounds like getting halfway pregnant to me, and since I'm not capable of getting fully or half,
That doesn't exist.
I don't kind of get that, because you train your dragon. If he is, you can use a dragon, you can use an arson, you are the catalyst. So if he comes, and you're the one who taught me this, which is basically he knows. I didn't know that he knew, but he knows that once you've cut by 3 times and you go to the 4th, he knows that that's bad. Because
that
now
is the line.
He's acknowledging that A, the first 3 things that he did didn't have any causal impact that was positive to the economy, and B, he's got to do more because he's getting more concerned.
Well, housing starts are on fire, and home prices have started to go up again.
Yep.
And that's great.
But
that's fantastic for the millennials. They're so relieved that they were almost able to get into a house, and then home price.
But if we just let's just say, and you guys can show it on slide 14. Our GDP nowcast is way below what consensus is at right now, and we're way more accurate than consensus. So this is why I care. We're at 0.5% GDP for the 4th quarter. 0.5. We haven't seen a 1, never mind a 0 in front of GDP.
That's a rounding error.
Okay, so that's a problem. So that's a major problem. So what happens if he says that, hey, we did our 3 and we're good, willfully knowing that he's got something in the credit market that's not good, which we can get into the mechanics of that.
Yeah.
Like, can he be the dragon or the catalyst, or the catalyst to get the market to go down again would be him just not being dovish enough at this stage of the game, if my numbers are right?
So if your numbers are right, I think that because something as fractional as 0.5% is truly a rounding error, you're a hiccup away from whether it's an unexpected. Everybody right now is saying inventories are going to come roaring back, and that's going to benefit the math. They're saying the trade gap has deteriorated so much that it's going to flatter GDP math. I mean, the logic behind it is not there, but I see it in the numbers.
Well, inventories, guys, show the inventory chart. I mean, it's already it's roared back to the highest point it's ever been at.
Yeah.
I mean, it's not like these are rearview mirror issues. But again, just park that for a second.
But they're anticipating that the manifestation of that's going to be in ISM recovering back over the 50 line, and there being some kind of a renaissance in U.S. manufacturing.
Didn't happen in November.
And hours worked in manufacturing continued to decline, and if you netted out the effect of the GM strike and downward revisions to October, by the way, you had a negative number in front of negative 1,000 in front of November manufacturing payrolls. So anyways, we're getting off subject here.
But if he adopts the bullishness that's expected, wouldn't that be like actually a hawkish
we know there's no
pivot?
rate cut.
Right.
We know there's no rate cut
That
coming.
sounds more dovish on the margin to me.
And we know that he's got some splaining to do. Now, the Bank for International Settlements has come out with a report that shows that it's not just a little technical glitch going on in the repo market, and that there might be beneficiaries beyond simply the largest banks that need to provide liquidity to the rest of the system. So I don't know that there's going to be anyone at that press conference with the stones to ask the question, but I sure do hope so. Because what we know and what we're seeing and what we're reading, and Zoltan Pozar at Credit Suisse, who's the smartest guy in the world, what the report that he put out last night suggests that what we're going to see in terms of year-end funding crunch is going to be worse than that of prior years, and certainly magnitudes of that of September. We've seen the longer-term repo operations that stretch into 2020 be oversubscribed. So that tells you that banks are trying very much to shore up liquidity through the year end. So somebody, if there's no rate cut, and if he's so happy with the economy and he's going to hang his hat only on the unemployment rate being as low as it was in September 1969, even though the economy went into recession in December 1969, if he's going to hang his hat on that and say the consumer is strong and the economy's in a good place, and he anticipates that business investment's going to come roaring back, even though Morgan Stanley just came out with a report that suggests it's going down in 2020. If he's going to do that, I think markets should be unsatisfied, because he's not going to be giving the patient enough heroin. They're going to want to know about.
Morgan Stanley would have in-house edge on that, as you'd call it, because they just fired 1,500 people today at the peak of the U.S. stock market. I might add, what could possibly go wrong? But that. So your answer is yes. I mean that if you are not dovish enough as we're entering the final countdown. So again, you can call it any part of the cycle you want. I'm calling it super duper late cycle, like 1969 type labor tight. And same thing as 2000 to 2001. Same thing as 2007 actually, when you started to see the rate of change in non-farm payroll growth fall, wages accelerate, profits come down, credit cared. If the Fed were to not go incrementally more dovish into that, that would have made things blown up faster. This guy could actually, on the margin, go hawkish.
He could. He would really be playing with fire. I mean, I think what he should say tomorrow, if he wants to stick to his 3-and-out football analogy and not even allude to the fourth, and right now there's a 50-50 chance. Rate cut in 2020 is a coin toss, according to the market.
Yeah, I think that's
at this point.
That's
total coin
huge
toss.
Opportunity.
Total coin toss. And yes, everything that you think you can buy cheap right now.
Yeah.
So if you want to go shopping and stuff your stocking, you got all kinds of cheap all kinds of stuff. But I'm just saying, some people like smaller packages, underneath the tree. But I think that if he doesn't give kind of a verbal reassurance that ample liquidity will be provided and leave that as open-ended as humanly possible, given that if the 0 to 12 month not QE that they're conducting right now proves to be insufficient at the turning point, because there simply aren't enough reserves out there, even though it's a hard subject to discuss. If they push out, as Zoltan Pozar said, into true QE4 and start buying what's on sale, that's what he put it, like the before Christmas sales. Black Friday in the Treasury market right now is coupons.
Yep.
And if the Fed is forced to go out there, they can buy some time. They can buy some more time if they launch true QE4. They'll have every Democratic presidential candidate breathing down their throat in a nanosecond, because that is a technical bailout of the banks, which is what they're trying to avoid. This is all about optics.
And of Trump. I mean, if that's what you thought all along.
Right.
This is my whole point.
And there's the irony. There's the irony.
It's like
there's no love lost. It's obvious that there's no love lost. The last thing he wants to do is get him reelected.
Yeah. Well, I mean,
and they're Republicans, theoretically.
Anybody, and you've said this, I think you tweeted it recently, actually, you're basically, you're actually much more polite these days on Twitter. I can see why. You have a louder and a larger audience, so it's nice of you to be
I have
polite
young
like that.
followers.
But I mean, you've all but said that if you think that this is what Powell has done to date because of Trump, you're an idiot, and I agree with that. I mean, but from here, if you precondition your dragon, let's just train this dragon and move him out. Okay, everything's fine again. GDP comes in at 0. Half the country that wants to believe it was always 0 now really believes it's 0. And there might be people above the 50% of those people.
They're on my Twitter
feed
feed between 1 and 4 a.m.
Just drinking.
All of them.
Just getting hammered.
The world's going to end.
Yeah, it's over.
Now.
So you and then you walk down the line, and this guy is still not dovish enough. Then the catalyst for him to be dovish enough is not being dovish enough. Therefore, if I'm right, and it's quad 4, what we call quad 4 in Q2, which is also our forecast, 100% of the time that the Fed sees quad 4, they have to go dovish. Because credit stops trading, and S&P's down 20% in a straight line. So then he would look like as politicized, if that's what you're looking for.
Yeah.
The preconditions are there for him to look as politicized as he's ever looked.
If the bulls on Wall Street are right, and we have a fundamental reacceleration and underlying GDP growth in the United States in 2020, then Powell can pat himself on the back.
Yeah, he can smooth right out of this.
He can.
Yep.
If anything goes wrong anywhere, then he will either have to increase the size of QE, formalize QE, and start buying coupons, or lower rates, or both.
Yeah, both.
In an election year.
Yeah, I mean, if the relationship between, I want to get your thoughts on this too, because this is classic late cycle labor. So the only other thing you have to solve for is consumption's rate of change slowdown in the face of labor starting to go the wrong way, which it's already going. You guys can show slide 39, I think it is. The rate of change of non-farm payroll growth has been slowing. It's gone from 1.9% to even Friday's number, which people don't look at a rate of change because they're also
gone
idiots.
to 1.5%.
Yeah, so that's what's happening. So as you can see, the green line and the black line, the spread widens right before the pink bar. Pink bar is a recession, so we're there. So there never in the history, even Volcker, I mean, never in the history of monetary policy does the Fed not acknowledge that as the data, so what would also be happening is that jobless claims start to rise for the first time in a decade. Like what is the probability of the Fed and the market not asking the Fed for epic cowbell? QE plus cuts.
Until last week, which was completely monkeyed up because of the Thanksgiving holiday falling so late, but until last week, we'd had 7 consecutive weeks of continuing jobless claims increasing. That's not fade initial. Initial is a number that's the number of people who want to apply for who want to apply for unemployment insurance. But we had 7 consecutive weeks of continuing claims, that is, people receiving unemployment insurance, increasing.
Yep.
So I'm going to wait about 2 more weeks and see what continuing claims do.
Yeah.
Because we've got to wash through the effect of that late Thanksgiving.
Yeah, we at Morgan Stanley are going to wait for our managing directors to come to us with the bonus meeting, and then 1,500 of us get fired, and now we're going to actually file claims.
So, but if but look at what we do at Quill Intelligence is we live in the weeds, and that's not to say we smoke the weed. We do not. We live in the weeds, and what the weeds are telling us is that the top tier of income earners in America, that top third, has been more pessimistic on prospects for the job market than the middle tier for a record 10 months in a row. Never been seen. And that top tier, I think you call them boss. They're the people who hire people. In that middle tier and the bottom tier, they're the people who are employees. So the disparity between their outlook, specific as it pertains to the job market, has never been at such odds with one another for 10 months in a row in the history of mankind. And here we are today with fresh December data.
So again, there's no, like if Janet Yellen was, because she was much more in tune with the labor market, I mean, she had her, 19 different labor market indicators?
She did, but it started to go the wrong way, so she got rid of it.
But you don't have, again, we have a lawyer who's uncomfortable. I mean, I saw him at Cafe Milano last week in Washington. He looked uncomfortable there. I mean, I was like, it was
I don't know how he can be comfortable anywhere, because
he did not look
knows
comfortable.
I mean, how comfortable was Christopher Columbus? He was like, damn, I hope the world's really not flat.
You know.
Because Powell's in uncharted waters. He's trying something that has never been tried at the central bank ever. And people don't appreciate how unprecedented his actions are right now.
So if he's if I was him, I'd be uncomfortable, because you set yourself up for your own realities in life, and that's where he's sitting right now, right there at Cafe Milano, just sitting there.
Yeah.
And it was it's uncomfortable for me to watch the guy be uncomfortable, because if you can play it forward, you know exactly what he's going to have to do, and what if the world decides that it's Ben Bernanke time again, which is, hey, you're going really dovish here. What is really wrong?
And he does not want to go to the zero bound.
Okay, so just
He's
play that
opposed.
forward, and then how does the Republican side of the aisles react to 0% GDP while he's panicking?
No, look, that would be a good way for a lot of incumbents to lose their seats in the upcoming election. But this is, if you want to know why Powell was so distraught at the cafe, picture him as being the guy in the ring with the lion, and he's got his whip out, and he's hoping that the lion has long since been tamed. But the lion keeps trying to scratch at him. The lion is CCC paper. And he has tamed stocks. He has tamed investment grade bonds. He's tamed every spot on the junk ladder except for CCCs, which refuse to come in. And no, don't ask the question. It's not energy. So, I mean, it is energy, but it's not all energy. So that's what frightens him, is that there is an aspect of the markets that are not coming to his way of mind. They're refusing to acknowledge the power of his not QE.
It's not. I mean, like you said, it's the repo market. It's all of CCC paper. It is the crappiest stocks. Don't forget that the Russell 2000 is still down 7% versus where it peaked last year in August. Guys, show the chart on 104. This is Danielle's making a very important point here, and I want to make sure that I want my mom to understand this.
Yeah.
When we go from C's to B's, she'll get the letters, but it's easier. Okay, if you know the alphabet and you have 11th grade math in you, you can understand this chart. So it's basically showing you, which Danielle just called out, the C's are the red line, the B's are the blue lines. 100% of the time that corporate profits go negative on a year-over-year basis, never mind before that as they start to slow, the red line starts to go up or credit spreads widen and the blue line chases it. 100% into a recession or not. So again, this time, the red line has left the building and the blue line has said, can Mr. Horsey, high yield year-to-date return, can you wait till I get into the barn on December the 31st before I take a ride?
Yeah.
I mean, again, that's never happened before. Ever.
And for the 11th graders out there, just remember that if you go one more notch in the alphabet, you get to D for default.
Yes.
So it's really easy. A, B, C, default.
And people, like, if you think that it's, first of all, 25% of high yield index now is communications. So it's like, the things that people love the most in terms of their CNBC stories and Tesla and WeWork. I don't think people would thank God they weren't long WeWork. At least most people weren't. You have to have actually a stock that these people can trumpet for people to get long, like Beyond Meat or something like this.
Well, millennials and baby boomers alike, their most concentrated position is Apple.
Yeah.
So.
Well, at least that's got it.
So anything that has anything to do with communicating.
But when you talk about like companies that need debt to fund their content, in Netflix's case, or their cars, cool cars like Tesla, that's the next frontier, because that's where corporate credit is gone.
Yep.
A lot of hedge funds brag to me about how they bought the Tesla bonds and crushed it. But at some point, if the bears are right on Tesla and the company doesn't make money, those bond bulls are going to get crushed. You got a lot of people in the B's that think that they're fine. But when I meet with distressed investors, what they say back, and this is another interesting anecdote, one of the largest credit fund managers in the world on the distress side, says, do you understand that there aren't enough of us to sop up all these Bs if they move towards Cs? We've made distressed managers extinct.
That's the thing. And the irony is that for all of the concern there is about the triple B investment grade slice of it, high yield could use a little bit more in the top rungs of high yield. They could use a little bit more paper right underneath the junk line. I mean, there's the irony there, but you're right. In terms of distressed, it's not there. Moody's put out, I don't often tout Moody's research, but Moody's put out a really good report.
Even they figured it out.
That basically said, we're a hiccup away, we're an earnings recession shy of the default rate going through the roof.
Right.
And there was a little reminder in there that the default rate going into 07 and 08, you needed a microscope to see it.
Yeah, real important point.
Unlike the prior 3 cycles when you had the default rate give you a signal in advance. Companies started to go out of business in advance, but how does a company go out of business in this world when there's no covenants to trigger?
Well, I think people have rethought that a little bit, but they've had to localize it, like to your point. This is an important point on energy. People say, well, it's just energy. All the stuff that I miss is just energy. And by the way, I'll never buy an energy stock again. People aren't allowed to buy it. That's partly why I like energy. I like it because of the quads, but anyway, it's a different point.
I think private equity is going to go flying into the sector. I think they're going to give them a little bit more life.
So you had 199 companies, energy companies, go away. I mean, it's not like these companies are immune to going away.
Right.
So I guess the other point is that if you look at slide 73, guys, the Wall Street expectation, I guess this is maybe in line with Powell's expectation. If he comes and says, I'm done with my 3 cuts, all good, he'd be looking at earnings growth accelerating from negative, which is clearly bad, to positive in the first half of 2020. This would have to be your expectation. If you want the C's and the B's, the red line and the blue line, not to meet, which they lovingly do in the end, to the distressed investor, not to everyone who's long risk, you have to believe that earnings are going to recover in the first half of the year.
Okay, so to your point, John Butters at FactSet, and I love it when people go after me on Twitter because I dare use FactSet data because it only goes back to 1982. I mean, it's just fly-by-nighter. So they actually looked back at the first 2 months of the fourth quarter, historically. They looked back 5 years, 10 years, and 15 years. They found that the first 2 months of 2019's 4.6% decrease in expected earnings is bigger than that of the 5 and the 10 and the 15-year average. We've had earnings expectations come down more than we have for almost 2 cycles. So what does that imply going into 2020 about all of those lofty expectations if analysts can't even keep up with downwardly revising what they're expecting for the fourth quarter?
Well, this is you made this was one of your tweets. Never have asset value. Never, and I encourage you to read these tweets, obviously, but never have asset valuation been so far beyond the underlying incomes. That actually, when you said 2 cycles, the last time you can show S&P 500 rate of change, what the chart looks like, which many of you just love the chart versus the rate of change of the earnings.
I'm not getting on that roller coaster.
Has never.
I mean, roller coasters are fun, but you can only go so high.
It's never done it before.
Yeah.
Other than the greatest bubble in the history of stocks for Americans. I mean, other stock markets clearly understand this. I mean, Singapore's down 3% in the last month. Plenty of global equity markets don't really get into the whole FOMO American chasing thing. They don't have CNBC. They probably think there's clowns or something. I don't disagree with their conclusions. But never. It's never before has the C's chart, slide 104 one more time, guys. Never before has that happened. Never before, other than the biggest bubble in stock market history, has the rate of change of the market and profits declined at this rate. Never before have we seen the unhinging of components of the labor market, of which you've already cited. So when does never become obvious to Powell? What does he need to see?
I think Powell would need to see what you're talking about. I think he would need to see, because what caused Powell to pivot in the first place was credit spreads gapping out.
Agree.
It was issuance coming to a freeze in the high yield market. There were, and it was redemptions especially. And when you start to study the leverage in the background and you hear things about prime brokers, and instead of actually selling underlying assets, instead they just kick up their leverage a little bit and raise cash that way through their prime broker, who doesn't mind, by the way, because then they get to collect more fees. And it's all good. It really is. But if you start to see a liquidity event, I think that's what's going to get his attention.
That's what I think. Isn't that the only thing? I mean, he doesn't.
I don't know. Nothing else gets his attention.
Yeah.
Nothing. And that's what people are like. Oh, but he cares about this. And I'm like, he doesn't. All he cares about is that the exchange traded high yield fund trades. It just needs to trade. The paper underlying it needs to trade.
That's it.
When that paper stops trading, when those bonds are trading by appointment only, Jay Powell's got a problem.
Mm-hmm.
And he'll know it immediately.
He doesn't just have a problem, like the problem associated with his job, the problem associated with his future jobs. I mean, his gig post the Fed is highly dependent on not screwing this up.
Well,
if he goes back, he's worth $105 million. You know that.
He doesn't need his pension. Look, for the same reason that Paul Volcker served, I believe, and took the 50% pay cut to go to the Fed. I think if you have enough money in this world, that you can say, I don't need to serve.
Yeah,
I put Powell in the camp as somebody who actually did not need to take on. He knew who was in the White House. He did not need to accept this job.
But what if?
And he did. So I think his wealth gives him cover for truly serving, which is why I think it's ironic that people think he's trying to get Trump reelected.
But what if his wealth was based on a promise that eventually you're our guy? Don't forget that people get rich by doing certain things, being willfully blind, being ignorant. If willfully, there are a lot of compensation reasons to be doing a certain thing. He was the perfect guy to walk into that seat. People didn't even know who he was.
And
he's a lawyer from D.C. He was not the ideologue that we've been used to at the Fed.
Yes, but in the fall of 2015, after Richard Fisher left the Fed and he and I met, he said, keep your eye on one person, Jay Powell.
Of course.
He's got his eye on unwinding the balance sheet. He's got his mind on normalization. He really did have truly noble intentions when he took on the challenge of being the chair of the Fed, and I don't think it's about scratching his buddy's back in PE. I just don't.
I believe 100% that the people that used to pay him were very much aware of what he could do at the Fed and what he would do and why. There is no doubt in my mind that they would have considered him the perfect person to have in that seat. He's a Washington lawyer with the power, of the private equity sector sitting right there in D.C.
I understand who's benefiting. I get it, and I understand who his colleagues are. But by the same token, I think that the abyss that Jay Powell saw was systemic risk that he couldn't identify a year ago.
Yep, and now he gets it.
And I think now he gets it.
Yeah.
But the systemic risk still hasn't been identified. A case in point, 140 Liberty Street, New York Fed, just throwing operations around and seeing what works.
Yeah.
So the Fed does not know where the risk lies. I think that they're getting a better idea. I think that international regulators are also getting a better idea. I think that some of the larger banks may be taking advantage of the Fed's
for sure.
printing press, shall we say. But I think he is starting to realize that it's a little bit closer to home because he's really good friends with a lot of people in the hedge fund community. And when there's nothing a hedge fund can do in a market that only knows indexing and going up forever, sometimes you do crazy things to take on leverage and make money.
Yeah, sometimes people do a lot of crazy things, that's for sure. If you have questions that are crazy or not, please submit them right here. They're getting rated, by the way, not by me, by your peers, thankfully. So again, if you have questions for Danielle, I know that there will be many. People are going to get into, like I was just, ironically enough or not, I was just in Virginia because I was in D.C., hence the Cafe Milano thing. I'm not trying to big time anybody, it's just where I was. But, I went to a credit hedge fund in Virginia. Relatively new credit hedge fund. I have not seen a group of human beings that are competent and successful be more concerned about the plumbing, as I think you've often referred to it, of this repo market. These guys were apoplectic about this. I mean, it begs the question, which is, who, if this continues to be one of the big signs of lack of collateral, lack of liquidity, the game has changed, all the regulations on the banks, who will ever be able to say that we didn't see that coming?
Well, I can't imagine anybody. I mean, look, the irony is that the Fed, the accelerant to quantitative tightening was at the Fed.
Yep.
The foreign central banks putting deposits at the New York Fed, you kind of see it if it's in your bank. So they knew that reserves, in addition to quantitative tightening, were being pulled out of the system. They knew that currency in circulation was increasing. They were able to keep a running tab of the fact that the quantitative tightening they were doing and the depletion of the reserves thereof was being doubled by foreign central bank actions and by currency in circulation increasing. So, and to fall back and say the banks said that they were going to have enough, I mean, that bank dealer survey has bitten them numerous times. And it's like, what are you going to tell Sister Teresa? I mean, you're not going to say, you're going to go like this, you're going to say 10 Hail Marys, but you're not going to tell the truth. And they're not writing on these surveys what is the true reality of what ample reserves really were. And they're finding this out the hard way, but they have to keep in mind these are not just the biggest banks and their duty to the world at large. They got clients, and they got clients who love leverage. So that's going to interplay with their motivations. And by the way, they also like to make money.
Well, the only thing I'd give them credit for them is their inability to see the interconnectedness of it all. Like I don't think that anyone at the Fed, for sure. I mean, there's certainly no blue chip economist who's outlined the confluence of China slowing, developing a current account deficit, funding their now deficit in dollars, and seeing European yields go negative. So anybody doing repo there not really willing to do that. Then all of a sudden everybody needs dollars. At a cycle high for the dollar, what always happens in Quad 4. Everything that I just said in the last 60 seconds or less, I would say probably understood by no one who's in officialdom. So how could they possibly understand that the timing of everything that they did would be impacted by the global interconnectedness of it all and the demand for dollars, the world's reserve currency? I mean, I think they're not willfully blind. I just think they're absolutely ignorant on that regard.
Well, I think, look, you're getting to an issue of culture here, culture within the Fed.
Right.
Because there are people in the financial community within a 10-minute car drive of the New York Fed that can help shed some light and would do so for the greater good of the financial system. In fact, they've been identified, and the New York Fed chooses to not consult with them. I'm not going to name any names, but that was always, to me, when I was on the inside and after, one of the most incredible aspects of policymakers was that if they couldn't home grow the knowledge base and they didn't like what was on the outside, they were just going to close their eyes.
Yep.
And that part, to me, is what's most dangerous. It's because you can go on my Twitter feed right now and there are a half dozen people who know a lot more about the plumbing than I do, but they're people. They're identified people. Bring their happy asses into the New York Fed, sit them down, give them a whiteboard, and have them explain what's going on in the plumbing and say, thank you for serving your country this afternoon. We're going to try and make sure the world doesn't blow up on our watch. And instead, they pretend like these people don't exist.
Yeah, it's a joke. And increasingly, these people are appearing right in the seat that you're sitting in. So you're, again, like, this is why
I created... calling me, Keith. No way.
But this is why I'm not to go off on some Hedgeye commercial, but I refuse. My service is to refuse to let people be fleeced by the old wall, all of these econs, and the establishment at large. That's just, we can do that by just having real conversations open. I know I'm not the smartest person out there, but I know I'm not conflicted and compromised like these people are. These people are going to be revealed in real time if this plays out in any way, shape or form, like any other super late cycle peak does. I don't know, it's kind of hard. It's like kind of trying to kill their bonds. It's like you can't get them out of their seat until it actually gets up in flames one more time.
So John Arthurs, if you missed it yesterday, put out a really great column. He's at Bloomberg now. He was at Financial Times for 28 years, but he put out a really great column that basically said the last time that there was this much Googling of the word recession and then it subsequently crashed was early 2008.
Yeah.
The last time people were like, whew, the coast is clear. That was 2008. 2007 was the run-up of concern, and they're like, and that is the public's perception right now. They see things, they don't understand that the Bureau of Labor Statistics cannot seasonally adjust their way out of a paper bag. They don't understand that there's 15 months of negative revisions through July of this year. They don't understand that there's more downward revisions to come because inflection points are very difficult for statisticians. It is what it is, but we're seeing these successions, and we know that if Canada has a negative 70 some odd thousand print, that the average print in the United States at the time, according to my buddy Dave Rosenberg, was 79,000. So an ADP is off of non-farm payrolls, but they're not all like on separate Indian reservations. They tend to trend together. So, but that's not what the public is paying attention to. Public is paying attention to the unemployment rate, the fact that jobs are being created, the fact that they're being told that this is the greatest economy ever, and the fact that the stock market's at an all-time high.
And the managers that run their money are paid fully to believe that until they get to the year-end check, which is based on the year-to-date return and what they get paid as a corporate. So we get
I lost a Daily Feather subscriber a few days ago, and I printed out his apology letter to me. He said, "I appreciate your fundamental analysis. It's better than any I've ever seen. However, it simply doesn't matter."
Well, we get into that part of it. I mean, if we had this discussion on December the 9th of 2007, you'd have those same people canceling Quill, enraged at Hedgeye, sending me one of the 1 million tweets you've sent me in the last couple of weeks.
Daily Feather subscriber. Weekly Quill people, they run money. They actually know what's going on. They know that this is not going to last.
But it's there. It's part. You need that. I'm going to start asking you some questions if you don't mind.
Let's go.
And this is again, and for those of you that
Okay, by the way, there are 3 words that I do know. I know I don't, followed by no. Okay, just FYI.
Which is awesome, and I love that about you. I mean, I think what a lot of you should love about anybody in this business, as opposed to what call they make, because you've been trained by that idiotic thought by CNBC to think it that way, is what insights are they providing around your process? That's, to me, that's who Danielle is. I mean, the highest rated question is directly a function of the last discussion that I had with her in front of you. Okay, if she didn't say that, you wouldn't have that insight. So importantly, number one, let's say 17 checkpoints on this one. That's a high one. Last time, hi Danielle and Keith, thanks for doing this. Last time you both discussed this, you said, Danielle, that after the 3rd rate cut, the market starts to not believe that central bankers can save the day. Curious to hear your thoughts if they've changed on that.
Well, so we have never survived 3 rate cuts outside of 1995 and 1998. And those 2 instances were in the beginning of an economic expansion. There was the tequila crisis. Orange County was melting off the planet. Greenspan was able to come in early on in an economic cycle. Cut. Off we went to the races. The moral hazard game picked up a little bit more in 1998. Long-term capital management. Russia was blowing up, blah, blah, blah. 3 cuts, ... Off we go to the races.
And the internet.
And the internet. And the mother of all internet bubbles, which I think, obviously, in retrospect, there was some dismay at letting the bubble continue to inflate knowingly. So my stock answer is, the last time I was here, Jay Powell had not fired up the printing press. And so even though I said that it was possible that we have rate cuts in conjunction with quantitative easing, I really didn't think he was going to do it. So not $324 billion worth between last time we met and now, because he's basically erased 50% of quantitative tightening in the blink of an eye. And the term operations continue to push out further. So 3 rate cuts out, market didn't go down, but we've never had a printing press.
In 1998, by the way, it was actually in our vernacular was quad 1, quad 2 central, where the full employment cycle peak wasn't until 2000. So again, you got to. I think what's key to this, particularly for people that are our age that actually lived through it, because there's one thing to have the theory and have studied all the cycles, but it's entirely another one to have gone through every single day of it. You have to have that super late cycle employment peak, which makes Friday's jobs number all the more ironic in terms of people's reaction to it. The next question, we have questions on the repo markets, and it'd be hard to summarize these. But here's a question that's particular to your own work. Danielle, in the past you discussed auto loan delinquencies. Please update us on your research, and thank you so much for what you do.
As I was taking a lovely drive up to Connecticut,
you were looking at this stuff?
I was looking at the Black Book latest, and according to Black Book, the declines in used car values headed into December have actually accelerated. So there's a process when it comes to cars in America. Cars in America are very important because they're completely agnostic to the trade war cycle. This is a secular global auto downturn. So what we're seeing right now with used car values come down at this rapid pace, the fastest pace of the year, is when used car values come down, that means that Joe Q buyer, who can't afford the new car in the first place, says, oh God, I'm gonna get less for my trade-in. If I get less from my trade-in, then I'm not going to be able to afford that really big truck that I want to buy. So therefore, I'm just going to sit on my car for a little while longer. And dealers, in turn, and we have seen used car dealer hours worked. We looked that deep into it, start to come down. And we've seen auto suppliers start to go out of business, as in bankrupt. Again, nothing to do with the GM strike. Exacerbate it, maybe. Start it before. And so I think what we will see in the coming cycle is that because subprime borrowers were able to only have kind of one relief avenue, only one place they could go, where if I don't qualify, I can still buy it, that's cars.
That's super interesting. I mean, forget the repo market and it just being an explicit view of collateral and illiquidity. Somebody's used car is absolutely their collateral.
Right.
I mean, we're not talking to Wall Street, obviously. Everybody's big
but I
time.
mean, the Wall Street Journal did some great work that showed, X percentage of people who are, putting 100% of the 50% of their old car loan into the new car loan. I mean, just crazy stuff going on. But we're a renter nation. That's the critical distinction.
That's a great point.
Prior to 07, 08, people didn't want to walk away from their mortgages. They didn't want to walk away from the roof over their head. The stigma's gone. Most of us rent. So many of us can't afford to buy a house, but where is your economic security? What's getting you back and forth to work? That's your car.
Yeah. This is a simple question, and thanks for boiling that down for people. I mean, this is the simplest question, but it's quite high in terms of rating. What are the consequences of the Fed injecting liquidity into the repo market? What are the consequences of that?
Well, the potential consequences of the Fed injecting liquidity is that the Fed is going to become the market. And during the tail end of the Fed blowing up its balance sheet with traditional QE, the Fed had begun to impinge upon natural buyers of treasuries. There were 40, 50, 60% of certain treasury QSIPs that were sitting on the Fed's balance sheet. And market functionality as we knew it was disintegrating. And it wasn't because Bernanke all of a sudden found his hawkish inner self. It was because mechanistically QE was no longer working. And I think that the real gambit here is that the Fed, and I think Powell is resisting this standing repo facility, because he could have, it was out there in June. They discussed it in June. He did not put it out there. But I think that the risk becomes that of the markets becoming permanently addicted to the Fed having overnight operations becoming the repo market.
That'd be standing QE.
It would be QE by appointment.
Yeah, but you're there. Like the Fed's, saying, look, we'll be here.
Yeah, and the beauty of the standing repo facility, which came out of the St. Louis Fed, is that the stigmatization of the discount window, because you don't want to necessarily identify yourself, hey, I'm at the Fed because I really could use some money, that goes away. So, but again, they have not launched this permanent facility because they want to call them emergency overnight operations of technical nature. But the implications are vast. The Fed could become the market.
Many would argue that it has to become the market because the markets can't deal with it any other way. Otherwise, you'd have to have the dealers buck up and stand there and provide repo. Right,
but we're starting to learn, not via Fed research, but by other research, other global regulatory entity research is beginning to let us know that banks have managed to find a way to arbitrage the opportunity in the Fed firing up these repo operations.
Great quarter, Jamie Dimon. You had a great quarter. Morgan Stanley, great quarter.
Mr. 25% of interest on excess reserves. One man, 25%. And that was a huge non sequitur, by the way. I went to another part of the Fed's operations.
But again, for those of you that have never seen a cycle before, it is absolutely super duper pro-cyclical for the latest point in the labor cycle for a bank to report glorious, better than expected earnings. Okay? Got that? Study that. It's important. Jason, this is a little bit off the rail, but maybe that's why it's getting some votes here. In your worldview, okay, why would Trump do a China deal? Do you have a view on that?
Well,
Worldview, China.
Is this a trick question?
No, it's actually, I get asked that question.
Okay, because he wants to get reelected? Look, China is the second largest economy on planet Earth. I'm going to get a little wonky for you just for a minute, okay? China has undergone the quietest colonization in the history of mankind. They are all over other countries around the world. They've made massive investments in their natural resources, in their ports. They are quickly becoming a global superpower, and not just economically speaking. So I don't take the situation with China lightly. I think that the Chinese government allowing as many defaults as they have is strategic. And they're trying to figure out what to do with their own financial system insolvency, which they've got little fireworks breaking out at this small bank and this small bank and this small bank. So they've got a lot that they're struggling with right now. But I think they could pay up for soybeans. I really do. And I think that they know that Trump will do anything to get reelected. So as watered down as this phase is going to be, didn't the December tariffs go out the window this morning?
It could. I mean, just extend and pretend. It
Right,
doesn't matter.
sure. But
Yeah.
the simple answer is because Trump will do anything to get reelected.
And money managers will do anything they can to get the horse in the barn until we get to December the 31st.
Sure, of course.
So I do think that GDP number changes. Again, Q4 is reported at the end of January, as you know, on GDP. Yeah. The lens changes. People start to go, oh, I don't have year-to-date at my back anymore, and that's another big part of the story.
People won't care.
Yeah. Well, the lens of the quads is how I try to answer that question, which is I have China in quad 3. By the way, if you didn't see, it was an 8-year high today in Chinese inflation, which only perpetuates the ongoing consumption slowdown in addition to their secular industrial slowdown.
Right.
And so we have them slowing all the way into Q2 of next year when the U.S. comes out of a zero handle on GDP and hits quad 4 again. So both the Chinese and Trump are not going to get what they want politically or economically.
No.
And that's where most political problems are born out of, economic problems.
They are, and because the slowdown in China precedes the trade war, because we've seen so many months of slowing in not just in internal combustion engine car sales, but also in electric vehicles. We had a terrible month most recently. But because the slowdown has more to do with the fact that you can't re-urbanize a country, they've brought as many people into the middle class quickly as they possibly can. So their growth they have to go from being an emerging to a developed economy, which is a painful journey.
Done by nobody without pain.
But they run their country a little differently.
Yeah, a little. I mean, maybe last question on this. Like if there's, I don't like this question, but people are asking it a lot because people want to boil everything down to one thing. Hopefully if you've watched us speak at all, there are many, many, many more things than one thing. It's lazy to assume that there is. And actually, I don't even think I can ask you that question. I'm not going to ask you that question.
Okay.
You know, that's not, because there isn't just one thing. Unless you think there's one thing. Is there one thing that if you woke up and saw it, you know, tomorrow morning when you get up and do your job, which you do diligently every day and are so kind to share your thoughts for free on Twitter with people, like is there something that you would wake up to say, oh my God, I can't believe that just happened?
Liquidity.
But that's not, it wouldn't shock you.
It wouldn't shock me, but to me, liquidity is the only game changer.
Oh, it's a game changer. Okay. On the margin, it would become what you think it is?
If there is a liquidity event of any kind, from anywhere on planet Earth, anything that pulls liquidity out of the system that cannot be compensated for by Jay Powell, that's problematic. But again, I think we have true QE4 coming. I really, really think he wants to see what it looks like to have something bigger than an internet bubble and a credit bubble get together in a bar, sit down. I think he wants to see what this looks like and buy as much time as he can. And if you really want to go there, then go full throttle QE4, but watch out because modern monetary theorists are going to come hunt you down.
That will be the topic of our next discussion. So we're up at the hour mark, and thanks for being so flexible and just open and honest about everything on topics that people want to know, that they think that they know. But I think after listening to you, they know more than they knew, and that's important.
I think I understood you channeling Yogi.
Yeah,
we're good.
You know, that's
and
it.
And everybody, please remember Paul Volcker. I'm wearing black for a reason. Yeah. Remember Paul Volcker.
Yeah, Paul Volcker.
Our last independent Fed chair.
Rest in peace, man. He did it right. That's A Real Conversation with Danielle DiMartino Booth. You can find us both on Twitter, and we'd appreciate your feedback.